market's raging and the traders all shout. There's one man we're watching, his moves full of clout. Some call him evil, some call him foul, but I just smile and call him Daddy Powell. Will Jerome Powell nuke the market again? With a flick of his wrist, make fortunes disappear in the wind. Wall Street's a jungle, lions on the prowl, but a king of the jungle is old Daddy Powell. Oh, Daddy Powell.
Oh, Daddy Powell.
Every single time,
Every single time.
it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell.
Oh, Daddy Powell.
Don't bring me down.
Every single time.
It's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell. The numbers are flying, red ink and green. For some it's a nightmare, for others a dream. DJs are crying, theories disavow, all bending the knee to mighty Daddy Powell. Oh, Daddy Powell.
Oh, Daddy Powell.
Every single time,
Every single time.
it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell.
Oh, Daddy Powell.
Don't bring me down.
Every single time.
It's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell. The bulls and the bears are locked in a fight. Who knows if we'll feast or starve come the night? With a glance at the screen, I let out a howl when I see that old motherfucker, Daddy Oh, Daddy Powell.
Oh, Daddy Powell.
Every single time,
Every single time.
it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell.
Oh, Daddy Powell. Every single time.
Oh, brother, oh, brother, oh, brother. We're back. We are back. A little bit of a specialty show for all of us involved. We are about to, in a mere 14 minutes, get the next Fed interest rate decision where they're going to tell us that they're cutting the rate by 25 bips. But on top of that, we're getting the SEP, the Summary of Economic Projections. That's like the dot plot thing, kind of looks like a Christmas tree. That should be exciting. And then the party really gets going at 2:30, about 45 minutes from now, when we are basically going to be everybody's seeing some craziness in terms of the market's reaction to what Powell has to or has to not say. Someone just said, account blown. My apologies. That's a bummer. Let me remind you that the event at 2 p.m., that initial announcement, the market's going to move enough that you could easily do the 50-50 strategy. If you don't know what I'm talking about, basically you do some reverse engineering of how much money you need. Right before the event, you put on a long on one account, a short on the other account, and you hope that one of them goes in enough direction to get that max profit for you to basically get the test passed, at least in the world of Apex. I have a whole standalone video on it, but here's the quick math. On a 50K account, you're allowed to trade up to 10 contracts on a 50K account. If you're trading on NQ, you only needed to go 16 points, aka 64 ticks for you to pass. If you place that trade on one account long with the ATM where it's already set up for the profit, and then you do long on one of the accounts and short on the other accounts, the odds of you passing at least one is very, very, very easy. So best of luck. Actually, I'm getting some alerts right now as we're about to chit chat here. Some alerts are going off. What happened to Avago? Avago's popping. Avago just hit a new all-time high. Does that mean my play got filled? I sold, I'm short put premium on Avago, and I still didn't get a fill. I still did not get a fill. Who would have thunk? Who would have thunk? I'm very close to getting a fill, but Avago breaking out. And actually, crypto was moving for a second there. It went from 92 almost up to 93, moving $1,000 like it's nothing. Folks, all this is going down in 12 minutes, where the odds are telling us, yes, in fact, we are getting a 25 bips rate cut. We're currently at 3.75, 90% chance of going down to 3.5, according to the Fed Watch tool. According to Call Sheet, 97% chance, 96% chance of that 25 bips rate cut. So all of that stuff is pretty much known, as I've already droned on about endlessly, is yes, we are getting the 25 bips rate cut, but we have to pay attention to the FOMC EP, the Summary of Economic Projections. That will be populating right here, right where this white block is. Eventually, it's going to say press conference, projection materials, PDF. I'll be clicking on PDF. You could see this one. This is from the last time around in September. When I say the dot plot, I'm talking about this thing right here, where you see all these little dots, blah, blah, blah. So yes, we will be checking that out. It can be fun if you're degenerately on the right side of it, but I want to do something a little bit more fun, and I only have 10 minutes to do it, so I'm going to need your help. As you can see, folks, I haven't done this yet. I put $1,000 into the account, and we could bet on what will Powell say during the press conference. I had this crazy idea in Discord. Should we just take all the likely bets? Like, yes. Basically, if it's above 50%, take it. And if it's below 50%, take the no. Is that a crazy idea or not a crazy idea? I mean, I can literally do it with 20, which might be all these. Should we just take all these words? And once again, the bet is, will Powell say during his press conference? We could either take the no bet or the yes bet. And I'm thinking, what if we just take the likely bet on every single side? Is that crazy? Someone talk me off the cliff of doing this. Someone I feel like this is a genius idea. I feel like this is absolutely, here's, I'll kind of explain contracts. Well, I just want to bet in terms of $50. So what was that? Is that $60? Where do you see how much money? That's how much contracts it is. But I want to bet in contracts. How do I see if it's a $60 bet? It's not doing it the way that I wanted to do it. I guess, man, we're really slowing it down. Why doesn't it tell you the dollar side? 50 divided by 0.75. So I would need like 67 of these. Review. Oh, wait. I guess 70. Okay, right there. That's $50. Yes, submit. All right, let's do this one. All right, we're going to do 69, and then we'll do 68. That should, nope. Do I need 70 of these? We're just going to throw $50 on each of these. Submit that one. All right, we're doing this one. What do I need of these? 75. Yep, perfect. Cool. We're setting that one in. What are we doing on this one? Uncertainty 3 or more times. That's kind of an interesting one. What do I need? 78 of these? Nope. 77. Nope. 76 of these contracts. I'm on the wrong side. You guys probably can't fully see what I'm doing. Oops, I popped up to the wrong side. Let me go over here. 75 of these. Okay, perfect. We're throwing that bet in. Here we go. We got to just do these quickly. Time is of the essence. No, 70. No, 75. 76 of these. Yeah, that's close enough. Cool. Submit that one. All right, 76 of these. Yeah, cool. Submit this one. Dot plot. All right, we're getting into the realm of 50-50. All right, we are getting into the realm of 50-50 contracts. 55. Wait, what's the limit price? 80, 85, 90, 91 of these, 90, 92 of these. Dot plot's going to be a big one we're listening for. All right, so basically, I'm going to come back. Wait, why is pandemic dropping? All right, we're taking no on pandemic. We're definitely taking no on pandemic because it's dropping for some weird reason, except he could easily say, we haven't seen these levels since the pandemic, recovery since the pandemic, like a year in review since the, I could easily see him saying this word, which is why it's 50-50, but we're going no on pandemic. Tariff inflation. We're going to go yes on tariff inflation. 92 of these contracts. All right, cool. We're reviewing that. What about volatility? We're going yes on volatility. We're going to go yes on old volatility. All right. We're slapping this one in. Done. Now we get into the no's, folks. Now we very much get into the no's. You think I should just take no on all of these? Like he's not going to say stagflation. What's that one? Oop, let's take the no. That's way too many. Let's no. All right. We're taking no on stagflation. They don't think he's going to say yield curve. That one seems like I'm getting really bad odds on, but whatever. Consumer confidence. They don't think he's going to say consumer confidence. Dude, I feel like I'm getting some bad odds on some of these. But hey, it is what it is. Recession, dude, he's never going to say that word. He's never going to say recession. You know what? Whatever the leftover money is, we're throwing that on no on recession. Wait, no, but he might say we don't think we're going to go to it. We don't see signs of recession. Shit. I might have talked myself out of that because he might be saying it in like, hey, we're not actually going to be seeing that. I might have talked myself out of doing it. I was going to bet big on no on recession. Do we think he's going to say the word on quantitative easing and tightening? I guess we're going to take the no on quantitative easing. I need to get all these bets in. The market turns off at 2 p.m., so I don't have much time. ADP. I guess we'll just take the no on that. That one seems whatever. It's a random guess at this point. Everything in life is a random guess, folks. 80. All right. So we're basically trying to throw $50 on all of these. Oh, volatility, tariff inflation. There's a couple we haven't bet on yet. Unchanged volatility. All right. So we have some 50-50 bets. I'll let you guys pick on this, but you have to do it first. Wait, no. We already said yes, yes. Which one have I not bet on? Wait, I'm confused. Cash. How do you know? Are these the only two I haven't? All right, I'll let you guys pick this one. The word unchanged. My question to all of you, and I'll take the bet that you guys tell me to make. Will Powell say during press conference, do you think he will say the word unchanged? Yes or no? That is a wide spread, my guy. Yes or no? The odds are leaning towards no for the word unchanged. What do you guys think? I need you guys to go fast. Like we are unchanged. A lot of you guys are saying yes to unchanged. All right. Stop yelling at me. We're going to do it. You guys are really feeling it. I don't know why you guys. All right. If you guys think that's what he's going to do, I guess we're getting it in. I think we're pretty much good. We have a lot of bets going. A lot of bets going right here. We're saying no to ADP, yes to Beige Book, no to consumer confidence, yes to credit, yes to dissent, yes to dot plot, yes to goods inflation, no to pandemic, yes to probability, no to QE, no to recession, no to stagflation, yes to tariff inflation, yes to uncertainty at least 3 times, yes to unchanged, yes to volatility, and no to yield curve. Look at that. We got all those bets in, dude. I can feel it. This is going to be a big payday. So the portfolio started with $1,000. So that's the mode that we are checking it afterwards. That is the line in the sand, $1,008. That's what we're going to see if we can beat that or not. All right. We put those bets in, dude. We got them in. Let's see. Dude, I think we might sweep. Dude, call me crazy. But something deep in my loins tells me that we might sweep on all of these. Who are you betting? Against other people that took the other side of the bet, I guess. But here we go. The account started with $1,008. We're earning a 3.5% APY, but we're either in it or we're not for the day. We basically put $850 on the line. Anyway, the results are coming out very, very quickly. If you're trying to degen it, yes, Apex is a good option. Funded Futures Network, Take Profit Trader. Look at the times of when you're allowed to trade and not trade, but neither of those have 1 day to pass. So that is something you have to be careful of and cognizant of. But anyway, yes, shout out to Take Profit Trader. Shout out to Funded Futures Network and Apex. All of them, if you use the code Goonie, you're going to get a nice fat discount. But in the meantime, let's get over to this bad mamma jamma. Let's get up the old, things are getting wild when you get the 15-second chart up. Things are going to get a little bit wild when you get the 15-second chart up. All right. So once again, we know it's going to be a 25 bips rate cut. We are aware of that. That's not the surprise. The surprise is what's going to be in the SEP. And basically, we're looking at how things have changed. So they always give you the recent projection. So in the new one, it'll say September projection, and we're going to see how they all update. We're looking at the change in GDP, unemployment, PCE, core as well, and then also the Fed funds rate. So we're going to be looking at these changes pretty much out of the gate. And hopefully, just hopefully, they bring on our boy Rick Santilli. But folks, we have 30 seconds left. And in these 30 seconds, first of all, I want to say thank you for helping me with all of these bets. But I need to ask you, bullish or bearish? Either speak your part or forever hold your peace, because folks, you have seconds left. Are you bullish or bearish? 15 seconds. I'm putting you on the clock. Answer very quickly. Bullish or bearish? Bullish or bearish? Bullish or bearish? 1 for bullish, 2 for bearish, 3 if you're rock hard, 4 if you're confused by the question, 5 if you have no idea. Go. Is it not out yet?
So if the labor data continues to weaken, if it softens further, then I think
it's not out yet. It's not out yet. We haven't
if
moved.
It doesn't,
then up. First move up.
Down the road.
Yeah, we're going to find out here in about 15
Here
seconds.
it is.
Like we said, it is.
Here it is. Here's the new SEP. Okay, GDP. Nope, that's not the right one. Okay, here's the right one. All right, so they increased GDP. That's good. Unemployment the same. Inflation down. Good across the board. Bullish.
Quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. Two were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith.
We're off to the races
dissent in a row. Also, another dissent.
It was
for a
legitimately
50 basis
bullish.
Point cut from new Fed governor on loan from the administration, Stephen Myron. To recap, the vote
right
was
there.
9 for cutting a quarter,
higher
2
GDP,
against cutting,
same
1 for
unemployment,
cutting
lower
50
inflation.
basis points.
Perfect.
The Fed
Bullish.
signaled a higher
Santa
bar
Claus
for
rally.
the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination. It is now at what it calls
a big differential
level of reserves.
3.75.
So it plans to
that has to be
purchases
mirrored.
of shorter-term treasuries on an ongoing
That's
basis. And then a
crazy.
separate document was specific, saying the
This is
Fed
the
will
Trump
begin buying
influence.
$40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up 0.5 point to 2.4%. So pretty big move there in the outlook for GDP next year.
How do
The
you feel,
inflation outlook
Timorous?
lower
Nick
for next year
Timorous.
by just a
There we
tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here.
They're going
Only
with
2
QE.
dissents,
That's QE.
But 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent in that regard, you can call it. 7 want no change at all for next year. 11 only want one cut next year. One person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or
That's this
150
guy.
basis points
That's
lower.
fucking
And
nuts.
that is the statement and the outlook for rate cuts and the balance sheet. Mr. Sullivan.
Dude,
Quickly,
it's
sir,
so
you
political.
said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like
It is.
the son of QE, quantitative easing
Yeah.
light?
Yeah.
You know,
Come
Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was.
Right here, the
Some
committee
people, however,
judges
will
the
call
reserve
it
balances at
QE
balance
light.
ample
Some
levels.
people will call it son of QE.
It's
I
QE.
believe the Fed will say
It's
this is
clearly
not neither,
QE.
that this is simply maintaining the balance sheet
come
at what
on.
they call the ample level of reserves, and that will cause them or prompt them to begin
Come
buying
on.
$40 billion of bills. It looks like 3 years. They also
Russell
may go out a little
loving
bit
it.
into
Spy
the bond
cues.
market as well, but they want to stick to the short end of $40 billion a month until about April, when they say there'll be a sharp decline in there. And Brian, call it what you will.
Let's
It's
see what Rick
QE.
Santelli
Grow
calls
up.
it. Steve, stay right there as you
Yeah.
continue to dig through this. The market reaction initially showed a very dovish tilt. We have stocks moving to
Yes.
session highs.
Oh,
We have
our
bond
boy
yields
Rick.
falling.
Rick's in
Rick, your
chat.
interpretation.
Here's our boy Rick.
Well, my interpretation, Steve nailed it. I don't disagree with social media going hog wild. They could put any spin on it they want. Ample reserves
He
to
knows about
deal
hogs.
with the reverse repo market issues, but it is QE, call it QE light. And once again, I have an issue with this, and my issue is simple. Every crisis, they expand the balance sheet by buying securities to manage rates or manipulate rates. Pick any M word you want. But in the end, this is something to really pay attention to. And finally, the markets themselves, we saw a couple of basis point drop pretty much across the whole curve. 358 down to 356 in a 2-year. 10s were hovering right around that 416 level. They dropped about 2 basis points to 13 and change. They're right back to 415. What's notable is where we were this morning, as Brian pointed out, the fact that we're toying with 420. Remember, we closed at 457 last year. We're getting ever close to unchanged on the year. On a year that many analysts and experts thought we'd be spending a boatload of time under 4%. We've had a total of 8 sessions close under 4% so far in 2025. The
Good.
dollar index, no surprise there. It's down about 1/3 of a cent. It was down about 1/4 of a cent before the statement was read. It's definitely toying with this 98 3/4 to 99 level. It seems to have lost its hunt for 100 recently, but that makes sense considering the Fed's easing. And finally,
gonna
the
send this
next
shit.
meeting, January. Many are talking about the January 28th meeting. For a while today, we had about a 30% probability of a 1/4 point ease. That's now moved to around 24%. It's been bouncing around a bit. If you look at the March 18th meeting, that's also hovering around a 25% probability of a 1/4 point cut. But basically, the real issue for 2026 is how much the market's going to pull out on the easing mentality as we continue to get data that certainly doesn't look like the labor market is dying a quick death. And in terms of inflation, not a lot's changed in the last 16 months. It's sticky, and it doesn't seem to be coming down closer to the Fed's target.
Rick, appreciate it, and we'll circle back in a moment. But let's get more from Mike Santoli. Mike, on what jumps out to you about the market's reaction here and what the Fed just told us.
Yeah, sort of net positive. I wouldn't say it's a real vociferous reaction. Obviously, it's during the press conference
that SEP is strong. That's bullish. I think Santa Claus is coming to town, folks. I'm calling it. I see 7,000 plus in SPX by the end of the year.
Value over growth, cyclical stocks over defensive
I'm calling
stocks, financials leading, especially banks. That has meant that the market has been kind of revving in this direction of anticipating a firmer economic performance in the early part of next year. We could be proven wrong on that, but the market seems pretty resolute in trying that hand. And I don't think that today's cut and going on hold because we weren't priced for further cuts in the coming months is necessarily enough of a surprise to disturb that in any respect. I mean, if Fed was on hold from December of last year till September of this year, and we had other things moving the markets around, but it was not really a rates issue. So the longer term coming in a little bit in yield, maybe that does loosen things up a little bit, although I wasn't particularly alarmed at the level that long-term yields had gotten to in this run.
All right, Michael Santoli. Michael, thank you very much. All right, let's go back now to our panel. We got Jim, Francis, and David. Francis, I want to go to you because let's talk about the job market. And I'm going to compare the last meeting minutes, and you'll forgive me, I got to look down and read it. Here's what they said at the last meeting minutes about the job market. They said the unemployment rate is edged up, but remained low through August. So they said, oh, okay, it's edged up, but it's low. This year, first paragraph, the unemployment rate has edged up through September, hard stop. So they seem to be acknowledging that the job market has weakened a little bit. I guess that changes the odds of a potential rate cut.
I like your word a little bit, because if you look at a chart of the unemployment rate going back to the 1970s, it's only been this low 2 times over that period, Brian. So I'm wondering why this is suddenly not low, particularly that we've only seen what I would consider a normalization in the labor market. In particular, this hasn't been broad-based across all age groups. It's been really focused on young individuals in the United States. So is this really a labor market that's quickly deteriorating? It doesn't look much like that much-feared hockey-shaped movement to me. Meanwhile, inflation has been above target for 55 months. So if I was looking at the bulk of the data and I looked at that dot plot and I looked at the Fed's forecast today, I would be saying, oh, they must have decided to hold or hike in that type of environment. What I want to hear from Powell during this press conference is, how the heck did you convince this committee to end with a cut today?
David, did they convince it? We had 3 dissents.
Well, no, and it sounded like we could have had 6
more.
dissents. 6
They dissented on what they call the dot plots, which I hate that term. It's like the Fed's light bright, where they put in where they expect rates to be. 6 non-moves on that, 3 actual dissents. So 3 people, I'm sorry, I'm going to say this, 3 people chickened out. Well, they wouldn't go on the paper and say, I disagree.
Well, exactly. And you can see that from the language in some of the speeches that we saw after the last Fed meeting, which actually convinced markets they weren't going to cut today, because some of particularly the regional bank presidents, are really hesitant to cut, at least in what they say. But then when it comes to it, they give the kid another cookie. And actually, it's a slightly bigger cookie than expected, because they got this extra liquidity for the short end. But I do think this is more dovish short term, but still pretty hawkish long term, because if Steve's reading of this is right, they've upped their estimate of GDP growth next year by a lot. We've got all these income tax refunds that are going to kick in the first half of next year. That's going to push growth higher, regardless of what the jobs market is doing right now. And it sounds like there are very few members of the Federal Open Market Committee who want to do more than 1 rate cut next year. And if you're only going to do 1 rate cut in the year, when are you going to do it? Maybe you wait all the way until December. So we're going to have it's going to be interesting here with the Fed perhaps going on pause in the first half of next year.
All of that said, maybe we can put this on the screen. The tech ETF, we were talking about this yesterday on a 12-day win streak. Well, it's now in the green after this move up to possibly have a 13-day stretch that would be its longest in about 8 years. So that's meaningful. We also have silver and gold on the positive and on the rise. Jim Karen, I was just going to bring you in on this because it seems, and I think John Spallanzani's phrase captures this perfectly, that he says the repo vigilantes won. Because the big headline for a lot of people, even those who are more bearish on bonds, is the Fed's back, they're buying, and they're doing so. Maybe it's just bills, but it's significant that this action is now coming a little bit more quickly than people thought. What does it tell you?
Hi, Kelly. Listen, I think that's a great way to frame this. On balance, this to me is a more dovish meeting. Now, yes, it is true. And I would really say that this is ironic, right? And I think we have to see the irony in this. The Fed has basically raised the bar for the next rate cut. right? So we still think they're going to cut, but it's going to be a higher hurdle for them to do that. However, they did surprise the market on the dovish side by moving that balance sheet management from what many people thought was going to be early next year to actually what's going to happen starting, right now here in December. The Fed is basically telling us that they want to have pro-cyclical policy, meaning they want to support the growth cycle. They're going to stand at the ready to cut interest rates if the labor market deteriorates further. And at the same time, they're worried about liquidity. They want to add liquidity back to markets. Call that reserves, call it what you will. The point, though, is that we need to get over the year-end turn, right? So liquidity constraints might come in at the end of the year. And the Fed wants to avoid that type of a stress in the marketplace. So net, the fact that they're willing to start to inject this liquidity, worry about reserves, and that's a lot of what's going to maintain, I think, some of the bullish sentiment in the markets, which is what we're seeing reflected, is actually the net dovish component, even though they raise the bar for the next rate cut. So I think it's a bit ironic.
Well, also, Jim, back to you, because a lot of people are listening or watching at home going, all right, this is great. What do I do? Well, to Kelly's point, the NASDAQ ticked up, the XLK on pace for its 13th straight day of gains. That would, I think, tie for an all-time record, or at least going back the 8 years. Why did stocks move up if prospects for more rate cuts went down?
Yeah. So effectively, one of the big concerns that was in the marketplace was that the Fed would have very inflationary policy, that they would be dovish and that they would push these long end rates higher because whoever the next Fed chair is, could potentially cut rates a lot. What the Fed is telling us right now is that they're not willing to do that. So what that's doing is it's stabilizing the back end of the yield curve. It's allowing the equity markets now to say, oh, we don't maybe have to worry so much about this inflation impetus that might come out of a Fed that's too dovish. So again, ironic. And that is actually something that's very supportive for the equity markets if rates stay relatively stable and well contained.
Yeah. And Steve, you want to jump in here?
Yeah, I wanted to back up what Jim was saying about the dovishness of the balance sheet decision. We asked in our Fed survey, which we released yesterday, about the balance sheet expectations, and it was for purchases to begin again in April. So this is quite a bit earlier, and for purchases to average just about 28 or 30 billion. So this is more than that. So on that front, for sure. I would also point out that when I'm looking at the immediate reaction of the market, it's a little bit more dovish in terms of that next rate cut. We had it more fully priced in for June before the statement came out, and now it's about a 57, 58% probability for April. That's going to bounce around. And all of that said, this entire discussion, I would point out, may go out the window next week when we get October and November employment numbers, as well as some inflation numbers, and we'll figure out if the Fed made the right call here and whether or not the forecast is worth either the paper that was used to print it or the digital space it's taking up on the web.
That's an excellent point. As always, Steve Leisman. Francis, the Fed has two mandates. I mean, people forget about that. We always talk about inflation because of what happened during COVID and prices spiked and inflation was 9%, blah, blah, blah. But they also have the jobs mandate, maximize employment. How do we read the jobs part of the picture vis-a-vis what the Fed may or may not do?
Yeah, I've been thinking a lot about this because I keep wondering to myself, how can you be cutting interest rates when inflation is this high and per our forecast going to be heading higher? In fact, it's really hard to see when that next cut is going to come through. I have to agree with David here. When is the window to do that? Because by February, we see that inflation side moving higher. And yet, Brian, this is not interest rate driven inflation. This is tariff level inflation. This is inflation that is coming from a labor market that is shrinking, immigration, retirements that are coming through. And part of me wonders if this Federal Reserve is saying our interest rate policy.
All right, this is getting to the point where they just have to fill up 30 minutes of airtime, so it's getting a bit boring. So let me tell you guys what's what and who's who and what you need to be paying attention to, because I'm sure some of you have some questions. So here's what happened. At 2 p.m., we got the announcement right here on the screen. 25 bips rate cut. We knew that was coming right here. We dropped from whatever it was, 3.25 to 3.5. So that's where we're at. 25 bips rate cut. Little bit of a surprise is they are hitting us with quantitative easing, but they're not calling it quantitative easing. So you have QE and QT, quantitative easing and quantitative tightening. The committee judges that reserves balances have declined to ample levels and will initiate purchases of short-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. So is it what we were historically taught is QE? No, but it is baby QE. So obviously we now have just another natural buyer in the market. Now, when you have on full on QE, go look at what happened in the charts in 2021, but basically markets just run to like an all time. So this is baby QE. It is no longer QT and it is not anything. It is baby QE. So this might cause inflation to go a little bit higher. It's not so extreme, but you have a natural buyer in the market. So that's the first thing you need to know. The second thing you need to know is that we got the SEP, the Summary of Economic Projections. As you can see, that also came out December 10th, came out today. So the first thing you're going to notice is in the September projection, the last one, they thought GDP for this year and for next year would be 1.6 and 1.8 respectively. They've now considerably increased that to 1.7 and 2.3. That is a big jump. Like, look for the year 2026. 1.8 all the way up to 2.3. That's a big jump in GDP. Unemployment 4.4 to 4.4. Good. It's staying consistent. Inflation, they thought it would be 2.6. They're now dropping it to 2.4. So they think unemployment will stay the same, GDP will go up, and inflation will drop. And then looking at core, same thing, a drop. And then the rate, they actually think it's going to stay at 3.5. Which is interesting when we know some of the members of the voting Fed here, the FOMC, are really aggressive in the drop. I mean, right here, FOMC, the appropriate monetary policy. This is Miran, who thinks it should be next year, next calendar year, in the next 12 months. He thinks it should drop all the way down to 2 by 2.5. So that's Miran. And then you still have some pretty aggressive, like this is, it's awkwardly oblong. There's no agreement. You have some members thinking it should actually go 25 bips higher. You have 3 members there. You have 4 members who think it should stay at the new level that we just got today. You have 4 members who think it should go 25 bips lower. You have 4 members who think it should go 25 bips lower. This is basically kind of being the average value for the year. 2 who are a little bit more dovish, one who's dovish, and one who's like really hardcore dovish. So once again, these are all the individual thoughts and opinions of where monetary policy should go. And this is kind of where it's averaging out to right here in this block. I'm surprised that 3 think there should be an increase. I'm surprised that 2 think, I'm surprised about these 3. This is a political vote. No one actually fucking thinks it should be there. Miran is just doing what Trump tells him to do. He's just Trump's puppet. There's no way someone who's actually studied the economy legitimately thinks that the Fed fund rate should go back down to 2%. Like this isn't a core economic thought. This is him literally just being like, just imagine Trump's hand up his ass and he's just puppeting him. That is what this particular vote represents. This has no like real thought or opinion on the economy. So you could basically nix that. No one cares about it. But looking at the rest of these, as awkward as I find these 3 is basically as awkward as I find those 3. So it's kind of coalescing in the lower to mid 3%. So we're probably looking as of now at 2 rate cuts for next year. So I just want to throw that out to everyone. You said he's talking. Who's talking? Powell's not talking until 2:30. Powell takes the stage in 30 minutes. So when you're saying he's talking, is Trump talking? Who's talking? When you say he's talking, come on, help me out. Help me, help you, help me. Help you, help me, help you, help me. Who are you talking about when you say he's talking? Who's the he? Because Powell is not talking. Powell is talking in 30 minutes. Did Trump go live? I feel like my producer would be yelling at me if Trump went live. So I don't think Trump is live. Yes, it does. The vote is to offset the others of the extreme Democratic side. Need more than 2% and we are good. Fight, 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 LFG. You have no idea what you're talking about. This isn't a Democratic vote. This is just opinion in the economy balancing out inflation. That's not it's not like the Democrats vote higher and the Republicans vote lower. That is not a correlation at all. Like unfortunately, you're just regurgitating some random thing that you heard. And Randy girl, you're now agreeing. Folks, that is not how this works. It's not like Democrats want to push it higher and Republicans want to push it lower. The only reason you believe this is because you've recently been hearing Trump saying rates should be lower. So you're assuming anyone who is voting higher is against him, especially politically. But that's not this. This is a different realm. This is the realm of economy through the lens of monetary policy. This isn't a left versus right thing. Okay, keep telling yourself that, Matt. Sure. See, this is what I'm saying is, the onus is on you to somewhat prove your point. I could prove my point by showing that there's no correlation between left and right leaning of where you are on this dot plot, and you're just saying, yeah, no, I'm right because you're just doing the hand wavy thing, and you think you're right. But I bet you're the same person who gets mad when on the other side it happens. You're like, hey man, show me the data, prove to me I'm wrong. And now I'm asking you on this, and you can't at all. If you think there is a correlation between this, you're making an assertion, and you'd have to show the evidence of that. You can't disprove a negative because it's a negative. That's not how proper debate goes. 2024 election just did. You're saying the 2024 election somehow proves the dot plot? You're just fucking stupid. Honestly, at a certain point, that's just dumb. That's just done. And the Fed, well, I could get behind that. I'm not necessarily saying I'm a fan of the Fed whatsoever. I think the Fed messes a lot of things up. They took our job. Once again, what does this dot plot on monetary policy have to do with their taking our job? You guys are trying to make something so extremely political that I would say there's a political aspect to it. I'm not going to be so naive to say this has nothing to do with politics. I'm just saying that your extrapolation has nothing to do with this. Yeah, it's just it's not even they're rage baiting. That's my issue though, is it's not even fun, intentional rage baiting. These people truly believe it, and you see these extreme left and right leaning people on both sides, and both the extremes are so fucking stupid that it's sad. You can't prove it. You literally got spun up by one speech or one commentary from the dude you voted for, and you took it as a truth, and you're I gotta run with it now because I was told that it's right. And unfortunately, the way Mirren is just getting puppeted by Trump right now, it's the same thing. At least Mirren's getting paid. At least Mirren is getting paychecks from the guy who is puppeting him. You're in the sad place of getting puppeted, and you're not even getting paid. That's the real sad thing, is you're getting puppeted for free. You have this dude's hand up your ass, and you're just regurgitating what he's saying. And at least Mirren's getting a paycheck for it. You're doing nothing. You're just doing it to do it because you think it's fun. That's the real sad part. But I'm telling you, maybe, especially if you're betting in it, if you're not betting, if you're here just to, I don't know, learn a little bit more and you want to bitch about the economy, whatever, it's your political opinion, live your life how you want. But if you're putting actual money on the line, it will behoove you to actually dive into this, because monetary policy is going to have an influence on both the economy and the stock market. It's not just going to be the Democrats are against us, the Republicans are against us. They took our jobs definitely from South Park. Oh, if it is, sorry, I haven't watched South Park in a bit. I do think it's hilarious. I just don't have enough time to, in my life, to agree with it. It's okay to agree with Trump. Yeah, it's okay to agree with Trump on things that he's right with. But this concept of, Democrats want higher monetary policy and Republicans want lower, there's no truth to that. It is, I fully agree. It is okay to agree with Trump on things that he is correct on, that are measurable, and we could prove it. But this is one of the things where he's just simply not. I don't know what to tell you, but this assertion that Democrats want higher monetary policy and Republicans want lower monetary policy, there's no correlation. Some Democrats want higher, some Democrats want lower. Some Republicans want higher, some Republicans want lower. There's no correlation between your political affiliation and where you think interest rates should be at. That's all I'm saying on this one. Couldn't you agree with them? Sure. If you want to agree with them on your favorite food, have at it. If it's also your favorite food, I don't give a shit. But on this one specific issue, that's not the correlation. And maybe in the future that correlation will exist. But at this moment in time, it simply doesn't exist. I don't know what to tell you. If it did, I guess we could talk about it. It just doesn't. What does exist, we're giving some back. So we did pop. We're giving some back right now. Did I get the fill on that trade? I did get the fill on that trade. That's an interesting bet. Your boy got himself into a little bit of a pickle over here. A little bit of a pickle. Well, this will be interesting. This will be an interesting one. All right, very quickly. So we also got that. So we're starting baby QE. We got the summary of economic projections. We're still waiting to hear the announcement of the next Fed chair. According to the Wall Street Journal, President Trump is kind of interviewing people and having discussions with people for this week. So maybe we're finding out pretty soon. So that's another thing I want to put on your radar. According to Polymarket, there's a 72% chance that'll be the current director of the National Economic Council, aka Kevin Hassett. So that is something that maybe they're going to ask about, because we know Jerome Powell, he's done with his position in May of this upcoming year, 2026. But what's really going to be fun in this discussion, once again, if you're just joining right now, Jerome Powell, the current chairman of the Fed, will be speaking in 3 minutes. This is the fun bet. I know many of you are degenerately betting on the market, and hey, whatever your bet is, whether up or down, I hope you're 100% right, and I hope you make a bunch of money. But what I'm betting on are words. I'm betting on what he either does or doesn't say, and I'm betting no to the word ADP, yes to the word beige book, no to the word consumer confidence, yes to the word credit, dissent, dot plot, and goods inflation, no to the word pandemic, yes to the word probability, no to the word quantitative easing, recession, stagflation, yes to tariff inflation, yes to uncertainty 3 times, unchanged volatility, and no to yield curve. So I need you guys to really be listening up, because we got a lot. He's going to be talking at 1,000,000 miles per hour, and we got to be clocking these bets of, is it working or is it not working? I put $850 on the line for him either saying or not saying various words, and we're going to see if it pays. We're going to see if it pays. Most of these have already shifted against me, unfortunately. It looks like I overpaid for a lot of these, so we're going to see how this gets going. But as we do or don't hear certain words, feel free to shout them out, because we're going to be tracking this as much as we possibly can. Maybe there's a way I can leave this up on the screen so we can see as it quickly does or does. I bet on a lot of words here, so we're going to have to be checking this. All right. Well, with all that being said, the conference is going to be starting in a minute or two. We have that up. All right. I'm going to put up 2 streams just in case one has better audio or something. All right. Maybe 3 streams. Okay. No, we're all awkwardly waiting on every single one. And Trump is not live. Watch live. President Trump participates in a roundtable as Fed decides to cut interest rates again. Oh, well, this is interesting. Which one should we be listening to? Should we be listening to Trump's roundtable? Or should we be listening to Jerome Powell? Or should we flip between the two? That one feels like it's going to get a little bit complicated of which one might be the important one. You know what we could do is we could double dip on this. I'm a man of means, and we could pull this off, folks. We have the capabilities. We have the capability to pull this off. All right. We're going to do this. We're going to do this. We're going to do this. All right. We're going to come back to the market over here. The market over here, as I said. And then what we're going to do, window capture, yes. Oops, I messed something up. I broke something. Public. All right, done. All right, they are not live yet, but I think you could see that. Let's see if I did it appropriately. It seems as if I did. Oh, here it comes. Everyone shut your mouth.
Goldman's in the camp that we could potentially get 2 rate cuts in Q1.
Shut up.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage
Volume
point.
up, you're saying?
As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral, and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy.
Say dot plot.
The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time.
We hit unchanged.
Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Dude, we're cruising. We're looking decent. I don't like he didn't say beige
Howard
book.
Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually
say dot plot.
Some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025.
Say tariff inflation.
So it would really be 1.9 and 2.1.
Say
but
it.
Overall, yes. For a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Say it.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers,
I'm getting
but
screwed
not a
on
big
beige
decline
book.
in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic?
I'm also getting fucked
you
on
get
dot
more
plot,
growth, but you don't
folks.
get a whole lot of decline in unemployment. Thank you, sir.
So it is.
I got
the implication is obviously higher productivity.
99 there and 99 there.
And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions
This is the question,
suggests
Colby.
that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January
Come on, Colby. Thank you, girl.
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to
Fucking
come down.
say dissent,
and agrees
pal.
that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook.
Dude,
in terms
he's doing
of
everything
what's
in his
going
power to
come,
not say
but
this
I think
fucking word.
Ultimately, having cut 75, and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm
He's doing everything in his power to
that,
not say it.
We're going to need to be
Son of
careful
a
in
bitch.
assessing,
That was the
particularly
question,
the
too.
household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not
rigged.
collected
Dude, the
in
game's
October
rigged.
and half of
It's
November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical
He's
eye.
manipulating
by
the
time of
market.
January
He
meeting.
should have said
Notwithstanding that,
dissent.
we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for
It's just plummeting.
for the
4%. He's just stealing my money.
We're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about
Come
it
on,
in a very
Kobe.
positive way, just given the
Come on,
complicated
Kobe.
nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to
Come
the
on,
Fed's
girl.
communication
She's
and the
got my
messaging
back.
around
Kobe's got
the
my
policy
back.
path forward?
We're going for the rebound.
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions.
He's not going to say it. I'm cashing out.
We always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very
That's
large
too
number
slow.
of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. It can't do two
Dude,
things at
she
once.
did everything in my
So
power.
At what pace do you move? How
I tried to get
what
out. I
size
was
moves
too
do you
slow.
make and that kind of thing. And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Dude, he's not going to say the fucking word. Suck. I got to give props to Kobe. She brought it up twice. Dude, she's my girl. She tried to make it
There's been some
happen.
discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths.
A travesty.
We won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down
on this.
to mean that, there wouldn't be a cut now, there'd be a cut in January
Ask
instead.
about the beige book.
It'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought.
Wow. We're going now, team.
It's come in a touch lower.
What a pop, dude.
And I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods. And that goods inflation is entirally in sectors
I got
where
out
there
for
are
break
tariffs.
even on that
So
one. All right.
That does build on the story, and so far it's only a story that this is that the goods inflation, which is really the source of the excess.
I got out for break
point, that
Damn it.
Almost
I got out for break
more
even,
than
but
half
he
the
said
source
it.
of the excess inflation is goods, is tariffs, and you've got to say then. So what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic. Heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous.
This is a travesty.
But overall, that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this.
He says goods inflation, but won't say tariff inflation.
Sometimes called
Seriously?
QT went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, you know, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, you know, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, you know, if you look ahead, you will see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Say credit.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. You know, we're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but you know, this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, then we try to, you know, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. Mag 7
popping.
It so happened that we've cut 3 times.
Popping.
You know, we haven't made
Natural
any decision
target,
about January, but as I've said,
flat.
we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And
really picking up.
Because of that, is jobs the threat to the economy?
So with tariff inflation, you know, there's the announcement of a tariff, and then
a little bit of a sell-off there. Natural target though at 50 on NQ.
Some months. Goods may have to be shipped from other parts of the, you know, it may take, you know, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of
back green.
For each one of them, there's
What
a
just
time
popped?
period, and then it's fully
Something
in.
popped.
So if there are no new tariff announcements, and we don't know that, but let's assume
Tariff
there are no
inflation?
major new
Oh,
tariff
he said it?
announcements.
Did he say tariff inflation?
from
99%?
goods, should peak in the first quarter or so, right? Or
We hit
roughly,
something.
you know, we haven't been able
We
to
hit
predict this with any
something.
precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even
Good
less. than
guys
that. We don't
win.
Really
The good
have
guys
precision
win.
on this, and after that, again, if there are no new tariffs that are being announced that will
There we go.
take 9 months to get fully in. 9 months is
There
also
we
an
go,
estimate.
Tonto.
Then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael
No
McKee
mulligans.
From Bloomberg Radio and
He's now
television.
said mulligan
10-year
more than
rates
he said
are
uncertainty.
50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're
Upside Gapple,
prioritizing
100 points
the labor
up on
market, which
NDX,
seems relatively stable to most
25887.
people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high
I already
costs.
got at a yield curve.
And
I got
a lot of
fucked.
that is not the current
Damn
rate
it.
of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So
How has he not
that's what's
said
going on.
probability?
And so the best thing we can do is restore inflation to its 2% goal, and our policies.
How has he not
is
said
intended to do
credit?
that.
I
But
got
also have a
boned
strong
on
economy
dissent.
where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling
He's not
economically
saying
healthy
beige
again.
book.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this
Follow
is
up
now
on
the third
dissents.
time that you've cut
Dissent
this
and
year,
credit.
and inflation is around 3%. So is
Wait.
the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs.
Say probability.
That's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market. Because the labor market, unemployment was very low, if you remember, when inflation was very high. There was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
He's now said tariff inflation multiple times, so we
Thanks
really
so much,
crushed
Elizabeth
that
Bolsey
one
with
right
ABC
here,
News.
tariff inflation.
Just to follow up, you keep talking about job growth being negative.
Talk about the
Why do you
beige
think
book.
Job growth is
Talk
so
about
much
credit.
worse than
Talk about
some of the
dissent.
official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers, and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. But really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know. But it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. You know, it's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
You know, it's not so stark as that. The views are more varied on in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you. Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people who are at the higher.
He definitely hasn't said it 4 times because this is
so,
3+.
As how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record. Yeah,
so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low low-rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move, and we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
I feel like it just got me out of something.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people.
He just said pandemic.
And that raises productivity, output per hour.
Stupid.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Couldn't say dissent.
Matt.
I've had enough of this shit. It's corrupted.
Thanks, Chair Powell. Matt,
he had to say it right at the end.
Today,
he had to say fucking
more
pandemic.
Meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that
your legacy's fucking me over.
I really want to turn this job over.
That's your legacy.
Whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control. coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And
I'm not having
I
a
don't
fun
have time
time.
to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Dude, it was literally the third to last question. He had to throw in the word
Even while
pandemic.
many price levels remain elevated, the
Fucker.
reductions in the federal funds rate means that savings rates, or yields, to be more precise, have peaked, while key borrowing rates
Why is
remain
this guy
elevated.
talking
And that's,
like
as
this?
we've discussed here, as many Americans struggle with liquidity
Mark,
or
why are you
emergency
talking like
savings
this?
challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and
I can't believe he
people
did
are
this to me.
innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
I can't believe he did this to me. What's this guy talking about?
Excitingly,
Is he
$3
still
trillion. Vietnam, Japan, the EU.
All right,
Malaysia,
he's going on
Cambodia,
about whatever. So they asked Powell, what does he want to be remembered for? What he's going to be remembered for is for losing your boy a unit and a half bet. I'm down. Every unit was $50. I started at 1,000, so I'm down 1.5 units after this whole debacle, dude. He just couldn't say dissent. He did everything in his power to not say that word. It felt personal. Honestly, legitimately, that felt like a hyper personal attack on me to not say that word. I can't. And then right at the end, he had to say pandemic. He's like, you know what? I'm not just going to fuck over Matt Kohrs by not saying dissent. I'm going to sneak in the word pandemic right at the end. So he didn't bone me once. He wanted to bone me twice, and he got it. You happy now, pal? Of course he's happy. That was his entire goal, was just to screw me over. Just to, it felt beyond personal. I don't know what to say. I went from liking the guy, and now I might have to completely rethink my opinion on the dude, because that, you have to admit, he kind of went out of the way to screw me over. That's unfortunate, I suppose. That is it's a cruel world. Sometimes that's the way the cookie crumbles, and here we are. Anyway, folks, the market's looking great. Very bullish. SPY popped, Qs popped, Russell popped. I believe we're going to be seeing new all-time highs by the end of the year. In fact, I take that another level. I think we're seeing 7,000 on the S&P 500 before the end of the year. So we're going to see how that gets going. We're going to see how that gets rocking. But overall, it was a very bullish update from the Fed. And I think the market's going to take it in stride. I really do. I truly, truly do. I hope you made a buttload of money today. And if not, I hope you make a buttload of money tomorrow. Folks, that's what I have for you. We're going to be streaming once again tomorrow morning, 9 a.m. bright and early, where I degenerately trade my futures account to see if I can make back some of that money that Powell lost me today. So stay tuned for that. I do appreciate you stopping by. And like I said, I appreciate the good vibes. I'll catch you mañana. Have a good one. Peace.